Well, hello, everybody. Thank you for joining us for the October edition of the Retirement Plan Academy. Today, we'll focus on non-qualified plans. I'm Kevin Fillers with the Trust Company of Tennessee. I'll be your moderator. We have, on here. We have also Chad Schollert with the Trust Company, as well as Bill Robinson with Baker Donaldson Law Firm. And I can't get the slides to change here, guys. There we go, sorry. So Bill Robinson has broad experience in all areas of employee benefits, including pensions and welfare benefits. He has extensive experience with 401k plans and 403b plans, having assisted many companies of all sizes in designing such plans to take maximum advantage of the benefits they provide, both to the employer and employees. Bill represents both for-profit and tax-exempt employers with respects to non-qualified deferred compensation and other areas of executive compensation, including designing, drafting, and advising with respects to tax implications of such plans. So, Bill, thanks for joining us, and let's jump into the presentation. So our agenda for today is to cover qualified versus non-qualified, additional retirement savings versus a golden handcuffs plan, non-qualified deferred comp plan usage stats, and some case studies. So here is our first poll question. What does it cost to replace an executive level employee?
So this is based on a study from a company called Built-In, and they estimated executive level employee replacement. And what do you think is the closest answer here? Go ahead and bring up the answers. We'll see what we have. Oh man, pretty good. We've got a pretty savvy group here today. So the study that they did was 213%. So you guys are on top of it. You know exactly what what it costs here. Good.
All right, so we'll jump into the actual meat of the presentation.
Kevin, we probably want to remind folks about the CPE credit.
Yeah, sorry, so just a little housekeeping for today. So if you have requested CPE credit, you must stay on the webinar for 50 minutes, answer the 3 poll questions, complete the evaluation form at the end of the webinar, and your certificate will be emailed to those who fulfill the requirements. So thanks for reminding me about that, Chad.
Yeah.
So now we'll jump into qualified versus non-qualified deferred comp.
Yeah, so I think probably most people on this plan are familiar with qualified plans like 401k plans, 403b. You know, most employers have some type of retirement plan that's considered qualified. Non-qualified plans are a whole different world and a whole different beast. And thankfully, we have Bill on the call today, who does a lot of work with non-qualified plans and qualified plans. But they're a special breed of a benefit. So generally, a non-qualified plan is a plan offered to a select group of highly compensated and key employees, allowing the delay of receipt of compensation. So it's really not meant to be a retirement plan necessarily. It's just simply, as the name says, you're just deferring compensation from today until some point into the future. So the rules are completely different, and we're going to jump into some of the differences between the two. But based on this definition, Bill, anything you want to add?
Yeah, let me just add one thing to this definition. I was looking at it last night, and I realized that we left out one important word in this definition, and that word is unfunded. What the definition should say is an unfunded plan offered to a select group of highly compensated and key employees. So we're going to talk in a little bit about what that means for a plan to be unfunded, because it's not as simple as it sounds, as that one word makes it sound. So, but that's an important distinction about non-qualified deferred compensation plans.
Yeah, and so that's raises a question. I mean, how can you have a plan that's unfunded? What does that mean? We're going to get into that. It's a little bit of a head scratcher. So, but these plans are, they're more common than you think, and they're called different things as well. So let's move along to the next slide here. We'll get into this. So there's some code sections related to non-qualified. You might be familiar with 457B, 457F. You may have heard of those. But 409A is the IRS code that actually governs most non-qualified deferred compensation plans. You'll hear these code sections thrown around from time to time, but those are for all the IRS nerds in the group. This is where to find these sections.
And Chad, I've always kind of.
I'm sorry, Kevin.
No, go ahead, Bill.
I was just going to say the one that's most important is the 409A rules. Right. We got to make sure that we either find an exemption from those rules so that we don't have to comply with them, or we make sure that our plan does comply with the 409A rules. And those rules are going to apply to a 457F plan. 457B is a little bit different, and we may talk about that in a little more detail in the future. But just keep in mind that 409A is, those rules are very important. In fact, even though they're very important, and even though the regulations go on for 50 pages maybe that describe how you comply with 409A, I was looking at looking around this morning on the internet just to see what kind of articles there were out there about non-qualified deferred comp plans, and I found an article by a law firm in the United States that says 409, the rules of 409A are fairly simple to navigate with the help of an experienced employee benefits attorney. I thought that was pretty funny. That's like a conundrum. It says it's simple to navigate, but you got to have a specialist to navigate. Right. So,
hey, we did have a question coming, guys.
Heart surgery is simple if you've got a great heart surgeon, right?
Exactly.
We did have a question come in. Somebody's asking, who is considered the fiduciary, or is there a fiduciary for a non-qualified plan?
Well, generally, non-qualified plans are not subject to ERISA or all of ERISA, but the employer would be the fiduciary in a non-qualified plan, because the employer is going to establish the plan, maintain the plan, administer the plan, so the employer would be the fiduciary.
Yeah, there's really not a way to delegate fiduciary duty for a non-qualified plan that I'm aware of, because as we'll see here in a little bit, non-qualified plan remains an asset of the company. It's not actually an asset of even if it is funded. It's not like it's somebody else's money and you're just holding it for them. It really is an asset of the company, so therefore it's hard to delegate fiduciary duty away. So let's jump into the chart.
One other thing we might say about that now, Chad, is that, as we have said, non-qualified deferred comp plans are available to a select group of highly compensated or management employees. And the IRS and the Department of Labor believe that those people are generally going to be sophisticated enough that they understand what they're doing and they can make decisions that are in their own best interest to a greater extent than rank and file employees who participate in qualified retirement plans.
Yeah.
Plus, as Chad said, there really is no money. I mean, you've got a promise from the employer to pay the money to you, but in a qualified plan, the money is actually put in a trust on an ongoing basis and invested for exclusive benefit of the participants. But we're going to get more into that in a minute. I don't want to get ahead of us.
Yeah. Let's pull up that chart here to compare non-qualified versus qualified.
Well, we do have another poll question that just came
Oh,
up.
yeah.
So
Here we go.
So here's our second poll question. Who can be covered by a non-qualified plan?
Yeah. So we've alluded to it a little bit here, but let's pull up that poll and just give us your best answer. You may know it, but
this will tell us who's been listening to what we've been saying.
Yeah. So pick the best answer here. I'll give you 30 seconds or so. And yeah, Bill, just for my seat, I've been handling 401k plans in some form or fashion for over 20 years in my career. And non-qualified plans are, my experience with non-qualified plans is less than that. And let's see what the answers are here. But reframing my mind from qualified plans to non-qualified plans, it was pretty difficult and still is difficult. So this is a little bit of a shift of perspective on these. Let's see what answers we got. There we go. We got it. Most people listening. Good deal.
Great.
All right.
All right, let's jump into the chart. This is a pretty a wealth of information here. So
yeah, we're just going to hit the highlights. So as we said, coverage for a qualified plan is really generally most employees. There's all these rules about discrimination. You got to cover at least 70% of those eligible. There's a lot of guidelines related to you really have to cover most of your employees. In a non-qualified plan, it's almost opposite. It really is only available to, as Bill said, your higher, highly compensated and management employees. The IRS, I'm not sure if this is any sort of statute, but I think generally they want this to only be available for the top 10 to 15% of employees. So it's really not available for all employees.
It's sort of a gray line, that 10 to 15%.
Right.
The IRS has never really said if you cover no more than 15%, you're good.
Right.
And we're gonna look at a case study later on that illustrates what I'm about to say, and that is that a select group of highly compensated or management employees can be a completely different number depending on the total number of employees that an employer has. So if you've got a company with 100 employees, you may limit your non-qualified deferred comp to top 10, 5, 6, something like that. If you're an employer that has 30,000 employees, you may have 1,000 people in your non-qualified deferred comp plan. So the number of employees can change depending on the size of the employer.
Yep.
And Bill, can you discriminate? So with this plan, if you have 10 highly comps, could you only cover 6 of those highly comps and discriminate the other 4 out?
That's a great question. Thank you for asking that question. I did want to get to that today. Yes, you can discriminate. Not only can you discriminate by saying we're gonna cover the 4 that we like the best and we're not gonna cover the other 6. You can say we're gonna provide X benefit to one employee and a different benefit to each other employee. You can discriminate among those highly compensated any way you want to. So you could say we're gonna benefit the CEO because we want to keep him. We want him to stay. We want to give him incentive to stay with us. We're not so concerned about the CFO. He can go, we'll get somebody else. Or we are concerned about the CFO. We don't want to lose him. So we want to provide him with some benefit. Or the CFO has come to us and said, you know what, I just looked up and I realized I'm not saving enough. I need to do something else. What can you do to help me? And the employer can do whatever it wants to do to help. But yes, you can discriminate among the people that participate all you want.
Yep.
Great. Thanks for clarifying that.
And something that's interesting kind of along those lines is, we're familiar with the the 401k limits, the profit sharing limit that you see there on the left side of the page, but in a non-qualified plan, there really is not a limit. So it's really open to whatever plan design the employer wants to create. So it's kind of a whole new world in relation to that.
Let me just mention one thing about that, one caveat to that, for those folks who are either tax exempt employers, work for tax exempt employers, or are interested in that area, and that is a 457B plan does have a contribution limit. And I believe it's the same limit as the qualified plan contribution limit.
Yeah,
So
that's right.
So it's also only available to a select group of employees, but it does have a limit.
Right. Yeah. Let's see what else on here might be a highlight. The other part about it being unfunded is a little bit of a mechanical puzzle, because most people think about, okay, well, I've got this money in this plan or what have you, but really the way that it works in most cases with a non-qualified plan is that money is a promise to pay, or some type of contribution is a promise to pay in the future. If it is funded, it's held as a company asset. The employee does not have control of it, or can't receive it. When they become vested, or when they're, depending on the terms of the document, if they leave, reach a retirement age, things like that, they might actually receive the money. And when they receive it is when it's actually taxable to them. And the employer will get, if they're a for-tax or a for-tax entity, they would get the deduction at that point when it goes to the employee, but up until that point, they would not receive a deduction. So it's a little bit different than qualified retirement plan world in that sense. And you can see some of the other details related to that. Anything else you want to add on this page, Bill?
No, I think you've hit the highlights on the tax part of it. That was good.
All right, let's move on to the next page. So we're familiar on the qualified plan side on distributions, and generally if you leave a company, you can take money out of your 401k, or if you reach 59 and a half or 65, hardship withdrawals, loans, we're familiar with all that kind of stuff. But in a non-qualified world, it's determined by the employer, the document that's set up, the terms of the document, which can vary drastically. And then the employee, in some cases, has the ability to defer receiving that money into the future. So they may be entitled to receive some money out of a deferred comp plan and be vested this year, but they could actually say, you know what, I don't want that money. I'm going to defer receiving that until another 5 years, and kick the can down the road a little bit further and receive it later. And so that is very different than the qualified plan world. So there's some other things here. We did want to talk about Rabbi Trust. We'll get to that in a second, but anything else you want to point out on this page, Bill?
Yeah, you ought to keep in mind that there's a difference in these distribution rules between taxable employers and tax exempt employers. A taxable employer can set up a plan that provides that the executive vests in whatever is put away for the executive in 5 years, let's say, but is not entitled to take the money until the executive separates from service. And that's okay in a taxable employer plan. In a tax exempt employer plan, it all revolves around whether there is a substantial risk of forfeiture for the employee. And once there is no longer a substantial risk of forfeiture, in other words, when the money is vested, then the IRS says, well, if it's vested and you can get it sometime in the future, we're going to assume that you could get it today, and we're going to tax you on it today. So generally what you see in a tax exempt in a 457F plan, which is the deferred comp plan for tax exempt employers, you see those set up so that the participant receives the benefit in a lump sum at some either a specified date or separation from service, or I have even seen, you know, a sort of a combination. You're going to get your money on the earlier of your attainment of age 62 or your separation from service. You can do that. But once that happens, generally in a tax exempt situation, the executive will receive the money in a lump sum. There are some limited ways that you can defer payment or have payment made to a tax exempt employer, tax exempt executive over time, but those are only apply to certain circumstances and probably is beyond the scope of what we're talking about. I don't want to get too far in the weeds. So, but just keep in mind that there are a few ways that you can extend the payment period for a tax exempt executive, but it would just depend on the circumstances. The other thing I wanted to say just briefly is I wanted to sort of qualify what you said, Chad, about the your ability to defer your deferred compensation. That's another one of those tripwires in 409A. You can do it, but you have to be very careful about how you do it. You have to, the person who wants to defer the deferral of their compensation, the payment of their deferred compensation, has to make that decision with, or rather more than a year before they're entitled to take the distribution, and they have to defer it at least, I can't remember, Chad, maybe you remember, 5 years or 3 years or something like that. 5 years. Okay, yep. So they have to defer it out another 5 years. So there are some limits, and you have to be careful of how you do that, or you can cause yourself a real problem with 409A.
Yeah. Well, the last thing on this page talks about plan assets protected from company creditors. And this is a really distinct difference between the two. So let's just say you have a company that has a 401k plan. That company goes out of business. They go bankrupt. They go out of business. Well, the retirement plan assets are held separately from the company assets. So if that company goes out of business, goes bankrupt, the assets of that retirement plan, that 401k plan, are not subject to creditors. They're protected, and the company, is not entitled to access those assets for, use of operating or anything like that. In non-qualified plan world, they are treated as a asset of the company. So what that means is they are subject to creditors of the company. However, one thing that we see often is a rabbi trust, and a rabbi trust allows for the money to be set aside, or the promise to pay set aside, so that the company cannot use it to operate out of. However, it is ultimately subject to company creditors. So, Bill, this is kind of a funny term, rabbi trust, but maybe you can give us a little bit of the background here and why it's called that.
Yeah. Before I get to that, let's go back to this concept of non-qualified deferred compensation plans being unfunded. That's one of the key points about a non-qualified deferred comp plan. It has to be an unfunded plan. And so the simplest thing to do, the simplest sort of deferred compensation plan that I can think of, is where the company would say to its CEO, we're going to provide you with an additional deferred benefit. We're going to put aside $10,000, and we're going to pay, some sort of rate of interest, 4%, 5%, 6%. We're going to pay that on the $10,000 that we're putting away every year, and we're going to put that away for 10 years. And whatever's there at the end of 10 years, you get based on the interest calculation. But there is no money put aside. It's a bookkeeping entry on the company books, and at the end of 10 years, the company has to come up with that, whatever it is, $100,000+ from somewhere. and pay the executive. And they could say, we're going to pay you over 10 years, or we're going to pay you over 5 years, or we're going to pay you in a lump sum. Whatever they decide to do, what everybody agrees on, then that's how the money will be paid. So if something happens between the time that the promise is made and the time that the executive is entitled to a payment, and the company decides it really needs to use the money that it was planning to use for that for something else, then the executive has an unsecured promise to pay by the employer that he would have to, file suit to get his money. So one of the things that employers would like to be able to do is put away the money so that it's only available to pay that executive the benefit that's been promised, and still call the plan an unfunded plan. So the first employer that tried to do this was a synagogue, and they did it for their rabbi, and they submitted it to the IRS and asked for a ruling that the plan would continue to be unfunded even if they put the money in a trust. And the IRS said, as long as the money that's in the trust is available to pay the claims of the company's creditors, if the company can't pay its debts as they come due, if the company declares bankruptcy, there's some triggers like that. And when those occur, the money that's in the rabbi trust can then be used to pay the claims of creditors. But until then, that money can't be used for anything else. The employer can't come back after that 5-year period and say, we really need a helicopter. We're going to spend this money that we put aside for the executive to buy a helicopter. You can't do that. So the plan then continues to be treated as an unfunded plan. But there's some rules that you have to follow. So, for example, the rabbi trust, the trustee of the rabbi trust has to be an entity that has trust powers. You don't want the CEO of the company, who's also the beneficiary of the plan, to be the trustee of the rabbi trust. So under the rules, you have to have an independent entity with trust powers to be the trustee of the rabbi trust. And Chad, I believe the trust company acts in that capacity for employers that need that service. Isn't that right?
Yep, we are a independent trust company with trust powers, and so we do have rabbi trusts and all kinds of other trusts as well. But yeah, we do have that ability. All right, Kevin, what do we got next here? I guess
the continuation of the chart.
Yeah, lots of charts here. I think we've talked about most of these. We could very easily get in the weeds on a lot of this stuff, but obviously with a qualified plan, you fund that money with cash generally. With a non-qualified plan, there's a couple, Bill has mentioned that it is unfunded, but there's a couple of ways that you can kind of account for this as an entity. You can fund it as you go. So like as somebody, achieves a benefit that you do set aside actual money for them. You can just decide to say, hey, this is just a liability on our books, and when somebody vests and when somebody gets paid out, we're just gonna pay it out of company assets, pay as you go. And then there are insurance products that you can purchase to fulfill the funding of these plans as well. So there's a couple different options. I guess we should probably say, there's all these different rules, there's all these different components of non-qualified plans. I think that if this is something that anybody is interested in, it's really the first step is to really understand what the goals are. What are you trying to accomplish? Because there really isn't a kind of like a prototype non-qualified plan. You really need to understand, okay, what are we trying to do here? Are we trying to retain an executive? Are we trying to pay out bonuses in some way that are deferred into the future? There's lots of different reasons for setting up a non-qualified plan, and as Bill mentioned, you can treat everybody that's part of a plan differently if you want to. So what are we trying to do here? And so I think that based on what your goals are, then you can back into how do you pay for it? What are you invested in? What are the terms that you create? Vesting, distributions, all of that kind of stuff becomes part of the conversation.
That's a great point, Chad. And Bill, am I correct in thinking that this plan is, even if you're putting money into that Rabbi trust, this is always a liability on the books?
Yes, it is. I mean, it's a promise to pay, and so you've got to come up with the money at some point. But I think Chad's point is probably the key point to take away today, and that is non-qualified deferred compensation plans are as flexible as your imagination. So you can figure out. So for example, in this top box where it says defined contribution fund as you go, defined benefit, you can have one where you say we're going to put aside a certain amount of money for you every year. You can have one that says if you reach a certain age before you separate from service, we're going to pay you 30% of your salary, 50% of your salary, something like that. And that would be more of a defined benefit type arrangement where you wouldn't even really know what the amount is that you're going to pay until the person becomes eligible to receive the payment. But it all depends on what the company's goals are, what the company wants to do, what the executive's goals are, what the executive wants, and how the company and the executive can come together to agree on some sort of compensation package that would meet both of their goals.
Yep. All right, for the sake of time, let's move along here and see what we've got next. So in some ways you can kind of put non-qualified plans into two general categories. One's where the goal is to try to save more for retirement or save more for the future, and then others which are more sort of golden handcuffs for executives or key people, and they're different setups, different types of goals, obviously, and we'll take a look here at what the differences might be. You might be familiar with the term golden handcuffs. You see that in headlines sometimes in the Wall Street Journal and things like that. But there is a way to create a plan that's more like a 401k mirror, where employees can defer additional money. And the reason that they would set up a plan like this is that maybe they're failing their 401k testing, their ADP and ACP testing. They have a hard time. Maybe it's a retail organization. They have a lot of employees. Maybe there's a lot of part-time employees that aren't interested in contributing to the 401k plan. Then they have also a bunch of executives that really do want to put a lot of money into a 401k plan. So the testing is really difficult. They don't want to do safe harbor. So you can actually set up a non-qualified plan that acts as a 401k mirror. The employees, the key or the executive employees could put additional money in to defer to the future. And so this allows the employees to contribute more along the lines of a 401k in terms of like how much they could save up to the limit. And you can kind of create the same provisions as a 401k plan. So these are, probably more common in very large organizations, but they are available. So this would be different than a golden handcuffs type of a plan. Bill, anything else you want to add here?
Yeah, let me just say that these mirror plans were much more popular before safe harbor 401k plans, when you really didn't have anything that you could do to protect your executives when you failed testing. Now you can put a safe harbor plan in place, but as Chad said, there's some circumstances. I think the example he gave, retail employers that have lots of turnover and lots of sort of not highly compensated employees that don't want to take advantage of a 401k plan. Under those circumstances, the employer may say, look, it's just too expensive to try to put a safe harbor plan in place. But we do want to help our executives who want to save for retirement. We want to give them a vehicle by which they can save as much as they can. And in that situation, you can set up one of these 401k mirror plans. The executive is not quite as protected as he or she would be in a qualified plan where the money, as we've discussed, goes into a trust and is not subject to the claims of creditors, because this money in a 401k mirror plan would be subject to the claims of creditors. But otherwise, you can invest the money in the same investment vehicles that you use for the 401k plan. And as the name implies, it will look just like the 401k plan. The distributions will be made at the same time, and everything will look like a 401k plan, except that the money will not be in a qualified trust.
Right. Yep. And then the other main type of non-qualified plan is really more for retention purposes or bonuses. You may hear about these types of plans in the headlines. You might not really know what this is, but when the executive of a extremely large publicly traded company gets let go or something like that, you hear sometimes that they get paid out, $26 million. Well, probably that's in the form of some type of deferred compensation arrangement where they are entitled to that money, and now they've had a triggering event where they've left, and so now they're getting all that money at once. And it's not really that they're getting some kind of incentive or payout because they got fired. It's really that they just have all this money in deferred comp and it's owed to them, and then there's a triggering event that makes it happen. So the purpose of these is really to retain employees. And as we talked about before, it can be based on performance, it can be based on longevity, it can be based on really whatever you want it to be. Again, what are your goals? Are you trying to keep somebody around till they are 65? Do you have a CEO that you really, if you tried to replace them, it would cost you a whole lot of money? So you set up a plan like this to incent them to stick around. What else, Kevin or Bill?
Well, one thing that we ought to point out, because it really is beyond the scope of our discussion today, is that a lot of deferred compensation is stock-based for corporations. And these big $26 million payouts that Chad alluded to generally are in the form of stock. If the company's stock has gone up in value substantially, then the executive is terminated, and the plan provides that he's entitled to a payment when he separates from service. Then he's entitled to that large payment in the form of stock generally, if it's a large payment like that. And we're really not going to talk too much about stock options and restricted stock units and restricted stock and that sort of thing. But those are other ways to fund a deferred compensation plan. You can set up a deferred compensation plan that provides, and pretty much everyone I've ever seen provides, that if the participant, the executive, is terminated for cause, the executive loses whatever benefit has been set aside or promised to the executive. I've also seen plans that say if you leave for any reason before you attain age 62 or before you retire, and retirement is defined, something like that, then you lose your benefit. So, but that one's a little harder to sell to an executive. So
yeah, and I think that's a great point, Bill, because you could say something like, you're entitled to get this money, or here's how we're going to determine the money that you're going to get in this plan, and it could be based on performance or longevity and all these things. And then if you say, well, but you're not going to be vested, or you're not going to be paid out until you're 65, and the executive you're trying to benefit is 45, well, that may not really incent that person to stick around. It's just too far away. So there has to be some thought process about, well, what are we trying to accomplish, and then how do we incent these folks to stick around with the plan that we put in place. So you might say something like, well, you can get a payout in 5 years, and then if you stick around for 5 years. We'll show you a case that we have here, client that we have here that we did just that, where the executives we were trying to cover were all different ages. So for one, sticking around till 65, not a big deal. Others, that really was a big deal, and we didn't want to tie them to that age. And so we created a plan that really helped incentivize everybody to be sticking around. So,
and another good thing about the flexibility of these deferred comp plans is, in the situation that Chad was talking about, you really could have set up several plans for different employees that have different circumstances. Another thing you can do, keep in mind, and this just gives you another example of how flexible these plans are. You don't have to have just one plan. So you could have a short-term bonus plan that says, if you meet the objectives that we've set forth, then you're going to receive a bonus based on the formula that is in the plan, and we're going to pay that to you at the end of the year. And then we've got a long-term bonus plan to help you, incentivize you to help the company grow over time. And under that one, you've got to hit other sets of objectives, and you get paid out down the road. So you could have one employee who participates in more than one plan. Another thing that we didn't mention yet that's probably important too is that you generally will put a provision in your plan that says, if there's a change in control, the executive will get paid.
Yep.
Or some of them have what's called a double trigger. If there's a change in control of the company and you either terminate your employment yourself for good reason, which is my duties are changed, my compensation is reduced, I'm required to move more than 50 miles away, those sorts of things, or you're terminated, then you get paid. So you don't just get paid because there's a change in control. One of these other things, you have to terminate your employment to get paid. So those are other methods for paying out somebody in the future.
Yep. Good point.
But all these have to be defined in the document, correct, Bill?
That's right. That's right.
All right, let's, what do we got next? All right, so this is, go ahead.
Go ahead, Chad. No, I was just saying we were looking at the usage stats. These are pretty interesting.
Yeah, so, most Fortune 500 companies have some type of non-qualified plan. I think that's where we see a lot of these types of plans. If you look at the kind of the next layer down, Fortune 1500 companies. But I think the point of this whole slide is that there are, maybe if you looked at this 20 years ago, you probably would have a very small number of plans in the small and mid-sized category, but they're becoming more popular and coming down market more and more. And I think it's two reasons. One is people are, understanding, and there's people like Bill out there that can really help companies, entities create these plans. But also the technology has advanced, and so rather than this being something that a company keeps on a spreadsheet in the CFO's office, there are record keeping systems and entities out there like the trust company who can keep track of all this stuff and help manage it for a company so that it's easier to deal with versus in the past. So things are changing, and I think that's why we're talking about this today, is that we're seeing more smaller companies adopt a non-qualified plan of some sort, and that's a trend that we anticipate continue.
I think that's a good point. My feeling about that is the thing you need to understand is, even though these plans are very, very flexible and can really work well, you've got to have somebody who can help you, who knows what they're doing. This is not the kind of plan, as Chad, I think, said earlier in our conversation, it's not a off-the-shelf prototype kind of a plan. So if you want to put one of these in place, you need to find a lawyer who understands how it works, and you need to find a company that can handle the administration and understands how the administration of a non-qualified deferred comp plan works. And if you can find that combination, then it's, as this article said, it can be simple to navigate, if you have the right professionals to help you.
Right. The purpose of this, go ahead, Kevin.
No, go ahead, Chad. I was going to say we had another poll question coming up here. So.
Yeah, go ahead. Let's hit that one.
Well, actually, I'm sorry, not a poll
Okay.
question.
So non-qualified plans can help employers with which of the following: retain key employees, attract key employees, allow key employees to save more for retirement, or all of the above. Let's see if you've been paying attention here. Just give you a few more seconds. And let's go ahead and see what our answers are. There we go. Everybody's paying attention.
Yeah.
Good deal. Well, we just have a couple more minutes.
Should we jump ahead to the case studies?
Yeah, let's hit one of the case studies real quick. And Bill just mentioned this already, so that's great. Yeah, and this is probably the best one, I would say, to cover. We had three, but we're going to only be able to cover one. So this one is a plan, healthcare company, privately owned. They wanted to reward and retain some of their key executives. In this case, they only really wanted to cover 6, and they determined who those were, mostly by position. And so this is a plan where only the company is making a contribution or a promise to pay in the future. The employee is not putting any of their own money or deferring any of their own money in the plan. So there is a couple of things here. One is that their formula they created is based on longevity. It's also based on their pay, and it's also based on performance of the company and their particular line of responsibility. So if the company does well, if they do their job, they're going to get a contribution or a promise to pay of some sort each year. Now, the way they set this up is that they vest over a period of 7 years. So in any money that they would get in 2021, it vests, and they're entitled to receive it in 7 years. The money that they get next year, or they're entitled to receive next year, is not going to vest for 7 more years after that. In 7 years, they're going to have they're going to vest, and they're going to be able to take this money out in the form of compensation if they want. So when they get to this period of time, as this builds up, each year that this money kind of builds up for them, the goal here is that they're going to always have money on the table that they would leave if they left the company. And so there's a little bit of a string attached. Even after the 7-year period, they're vested in some of the money, but not all of it. So they have an incentive to kind of keep going down the train, down the tracks here. So they worked with us to set up this design, and we explained it to the employees that were covered, and so it's working well, and it's achieving the goals. I don't think any of the executives that are covered by this plan have left yet, so that's good. All right, Bill, what did I miss?
Well, no, I think you did a great job of explaining that, and that's a really good and very popular plan design, because it helps the executive with supplemental retirement, and it provides golden handcuffs to keep the executive, give the executive incentive to stay with the company, especially in the healthcare area right now. I mean, I've got clients in the healthcare area who are scrambling, trying to figure out ways to keep nurse anesthetists and physician's assistants and people like that who can move and go anywhere. And you know, it is a good way if you can provide some deferred compensation. There are a lot of employees who will take that over more compensation today because they want to be able to have it later on. So this is a good example. One of the other examples that we are not going to get to illustrates the point that I made earlier, and it's a big public company with lots and lots of employees that provided non-qualified deferred comp for a fairly large number of employees, but a small percentage of the total employees of the company.
Yep. So you can see here that this plan covers only 6 of 750. I think our other example was, well, maybe move to that other page. Yeah, here it is, 200 of roughly 25,000 employees. So a bigger number, but also a bigger employee base. So Kevin, did we have any questions come in, Q&A that we want to hit before we wrap up?
No, I haven't seen any on the list right now.
All right.
We still have about 8 minutes, so we could, if you guys want to talk about this or this tax exempt example, we still have 8 minutes.
Which one would you want to hit, Bill?
Oh, either one. We could talk about the tax exempt because we haven't talked about that as much.
Yeah, let's go for it.
People in the audience who are interested in deferred comp for tax exempt entities. There are lots of tax exempt entities that use deferred comp, and a lot of times it's used to retain executives, but it's a little bit harder to do because of the rules that are set out below here, where it says lump sum distribution when participant vests. And I think I may have mentioned that earlier, but you can, under the tax exempt rules, as soon as there's no longer a substantial risk of forfeiture, the money vests and is taxable to the executive, whether the executive receives it or not. So there are a couple of things that I've done with clients in the past. One of them is to put in the document a non-compete provision, which says we're going to pay you out over 5 years after you terminate. But if you compete with us during that 5-year period, you lose the remainder of your benefit. So then the question is that a substantial risk of forfeiture? And the IRS has said it could be a substantial risk of forfeiture if it has teeth in it, if it's a real non-compete provision. In other words, can the executive really compete with you? And does the executive have the skills necessary to compete? And are there businesses that would hire the executive in a competing role? So I have used that in a situation where we had an executive that could have gone to a very similar business. This was a company in Nashville, and could have gone to several businesses in the Nashville area or around the state. And he's going to receive his benefit, I think, at age 62. So at that age, he's still young enough that he could continue to work for 5 years. It's realistic to think that he would continue, as long as his health is good, continue to work for another 5 years. We had another situation where a company wanted to put a non-compete clause in that was going to last 20 years and wouldn't begin until the participant retired at age 65. And we said, that's not really going to work, because very few companies are going to want your executives when they're 80 years old. So you've got to change that non-compete and make it more realistic if you want to use it.
Right.
So there are things that you can do with tax exempt organizations to assist, but you just need to keep in mind that the general rule is if you're a tax exempt employer and you want to provide a benefit like this, you have to do it. You have to pay it in a lump sum.
Yep. So Bill, maybe we can talk really quickly about like what are the steps that you would take if you were interested in setting up a non-qualified plan. I think from our end, thinking through like what are your goals, what are you trying to solve for, that's probably the place to start. But then what happens after that? We call you and we say, hey Bill, we're ready to rock and roll. What happens?
Yeah, I think you're right on. I think what an employer who's interested in doing this would want, the best thing to do would be to reach out to an organization like the trust company and sit down with somebody there to talk about the company's goals and what the options are, and sort of get a plan in place. I'm happy to have a company reach out to me, but you know, when you bill by the hour, if you can get the design, have some idea of what the design is going to be before you come to me, then the cost is going to be lower. So if you can get with a professional like you or like the folks at Trust Company to help you figure out how you want your design to work, what you're trying to do, then you can come to me, and I will always have questions. I got one just the other day, and it was a bonus plan, and the employer, you know, probably expectedly so, was more concerned with the formula. How are we going to calculate whether you hit the goal? What are we going to set as goals? How are we going to calculate those goals to determine whether the company has done well enough that you should be entitled to a bonus? Spent a lot of time worrying about that. Then I got their outline on how they wanted the plan to work, and there was nothing in there about who's going to be eligible, and there's nothing in there about when they're going to get paid, because they really weren't focused on that. They were focused on how do we calculate what the benefit is going to be. So I just got on the phone, talked to them, and we worked all that out and started on the document. So the design part of it is a very important part.
And then what do you do at that point? You say, okay, we're ready to set up this plan. What do you do?
I would draft the document. I can draft the resolution for the employer to the board of directors to adopt the document. And then you got to determine whether you want a rabbi trust. If you want a rabbi trust, those rabbi trust documents are easy to do because the IRS has provided sample documents. Sometimes, I don't know if the trust company has one that it likes to use. Sometimes the trust entities have a document they like to use. Sometimes they want me to draft one, and I'm happy to do it either way. And finally, there's one other thing you have to do. You have to send a notice to the IRS and the DOL that you have a deferred comp plan in place and how many employees it covers. You don't have to say anything else about it except those two things. And if you do that, then you're exempt from filing the annual 5500s. If you don't do that, then you're not exempt, and you're going to be in a world of trouble if you haven't filed 5500s. So that last step is one that you never want to forget.
And you do that when you set them up from your end.
Yeah, right.
And then at that point, as you said, there isn't any ongoing filings with the IRS or ongoing filings with the Department of Labor. That's it.
Correct.
Good. Kevin, anything we need to wrap up with?
No, just we appreciate everybody's time, and if you have questions, reach out to Chad, Bill, myself. If you're in Chattanooga, we have a Chattanooga office, Tri-Cities office, and we will be sending out the invites for the next installment of the RPA series. And again, thank you for joining.
Thank you, Bill.
Thank you, and thanks everybody who sat in and watched.
Thanks, Bill.